Well, good morning, good afternoon, good evening, wherever you are of our attendees watching this sixth day of World Arbitration Update. This is the 2023 edition. My name is Ian Laird. I'm co-founder and co-chair of WOW with my colleague, Dr. Jose Antonio Rivas. We founded and started up World Arbitration Update 3 years ago in the middle of the pandemic. And it seemed like a great idea at the time with the uptake in virtual meetings and the use of Zoom technology becoming the norm, that this kind of conference became made a lot of sense and became incredibly viable. And we're trying to keep it up because it helped meet one of the objectives, which I think there had been a disconnect in the past in the international arbitration world, in that international arbitration is clearly a worldwide phenomenon. It involves diverse and fantastic practitioners and arbitrators in all corners of the world, but all the conferences seem to be in New York and London. And we wanted to take the opportunity to drawing on the incredible pool of folks in the international arbitration community and be able to focus on issues and update those issues in particular on an annual basis that are relevant to folks and practitioners in all corners of the planet. And in this third year, this third rendition of World Arbitration Update has really proved that point of the kind of worldwide phenomena of international arbitration. We started the conference last week in Mexico City. We partnered with the National Autonomous University of Mexico Thursday and Friday last week. We had 8 great sessions in person and virtually on topics relating to arbitration in Latin America, investor state arbitration, and so forth. It was really a great experience, and we're hoping to replicate it again in the future. We had over 950 participants virtually and in person. It was a great success, and it's just kept rolling over the course of this week when we shifted focus to different corners of the world. We had on Monday Asia and Oceania Day. We had a session in Singapore. We've moved to Africa and the Middle East, and we had some great panels in relation to those regions. We covered off some European issues yesterday, like the Energy Charter Treaty and other issues. And today, we've saved, I think, the best for last. And we have 3 panels today, and I'll introduce our current panel and our moderator. I just wanted to give you a preview that we have 2 further panels today, one at 11 p.m. Eastern Standard Time and another at 1 p.m. The 11 a.m. p.m. What? Okay. Where am I? Don't know what continent. The first one is titled Investment Arbitration in War and Armed Conflicts. Can investment legal principles coexist with international humanitarian law? Obviously a very an issue of great importance and currency. And then we're going to finish off on a last panel titled The Code of Conduct for Adjudicators in International Investment Disputes. And we're very, as you can understand that, very much focused around the reform work and investor state arbitration by ICSID and UNCITRAL Working Group 3. And I think there'll be a lot of interest in that code, which will likely, it looks to be approved by the UNCITRAL Commission this summer. So we'll kind of give the final assessment of that process and look forward to the future of the Working Group 3 activities. So we're going to have a really great day. I wanted to introduce this current topic, but actually before I do that, I just wanted to take the opportunity of thanking some folks, in particular, and she doesn't get enough credit. Maria Lucia Casa has done a fantastic job organizing the conference. You've probably seen her name all over the place. We don't mention Maria Lucia enough, so I just wanted to mention her. And also thank Jose Antonio Rivas at X Strategy for his huge support and great partnership. And of course, all of our sponsors. We've had a great deal of support and participation. And as you can see from the 20 plus panels that we put together, we've been able to work with and highlight an incredible group of practitioners and arbitrators who participated in the conference. So I can't say thanks enough to everyone. So on to the business of this morning. Our first panel today is titled 2023, the year of near or full financial crisis. This is a question. An update of investment arbitration in financial services, the world of banking, prudential measures, and sovereign bonds. Now, clearly an absolutely critical topic, one that involves all of us in some way. And we put together a really fantastic panel. And our moderator today is Berglind Haldor's daughter, Birkeland. And Berglind is a member of the International Dispute Resolution Group based in New York of Debevoise and Plimpton. And she represents and advises both corporations and sovereign states and investor state and commercial disputes. She has covered off a range of industries, including mining, oil and gas, pharmaceuticals, telecoms, financial services, which is our topic today. She also advises investment firms and asset managers in evaluating investments in international claims or arbitration awards, also very pertinent to our topic today. She has her JD from NYU Law School and is also an alum at the University of Minnesota. Well, it's great to have you, Berglind, and I really appreciate you herding this particularly excellent group of cats. And I'll pass over the microphone and sit back, and I look forward to hearing the great discussion.
Thank you, Ian. So I have the honor of introducing my fellow speakers here today. We have an excellent group. So David Attanasio, he's currently counsel at the International Arbitration Group of Dechert LLP in DC. And he is very qualified to speak on this topic because he's the author of an award-winning book on international arbitration that is entitled International Investment Protection of Global Banking and Finance. So we're very much looking forward to hearing about his perspective on this. His practice concentrates on commercial arbitration, investor state arbitration, and cross-border litigation. And he works in a number of different industries, including banking and finance, but also energy and the mining sectors, among others. He is, among other things, on the board of directors of the International Law Association American branch and a member of the Global International Law Association's Rule of Law and International Investment Law Committee. He holds a JD from Harvard Law School and a PhD from the University of California, Los Angeles. Welcome, David. Happy to have you here. Danielle Morris is a partner of William Hale's international arbitration practice. She's also based in Washington, D.C. Her practice spans both private and public international law. She has 15 years of experience representing clients in both ad hoc and institutional arbitration under all of the sort of rules of arbitration that you would be familiar with. She's represented clients in a number of sectors, including the financial services sector, as well as mining, oil and gas, construction, pharmaceuticals, and automotive industries. She regularly advises clients on the substantive protections and dispute resolution mechanisms under various investment treaties, both bilateral and multilateral. And she's represented both investors and states in these investment disputes. And she's also advised an African state regarding boundary mediation. And she, interestingly, began her career as a legal advisor in the legal advisor's office of the U.S. Department of State. So she has that experience as well, coming from the state perspective. And then finally, last but not least, Michael Seelhoff. He is an independent valuation and banking expert. He has testified on valuation matters in international and commercial arbitrations across many industries. including banking, but also construction, power generation and transmission, oil and gas, transportation, telecommunications, and food. Before working as an expert, Michael worked in banking for 17 years. And during that time, among other things, he was chief operating officer of the investment bank of Commerzbank, Germany's second largest bank. And prior to that, he was responsible for Commerzbank's M&A transactions and for managing the bank's regulatory capital. He has a deep understanding of valuation of banks and financial instruments and of bank regulation. So we're very happy to have him here as sort of the token non-lawyer on the panel, which is really, really helpful. And he is a mathematician by training, but he also holds a second master's degree in engineering and management from MIT. So very qualified, as are Danielle and David, to talk about this topic. So very happy to have everybody here and to get to participate in this. So David, maybe I can start with you and invite you to just give us a little bit of an overview of investment arbitration in this sector. What are some of the things that kind of stand out to you regarding regarding arbitration in this sector?
Well, thank you very much, Berglund, and thank you to the organizers for putting together this panel and inviting all of us to speak. We really appreciate it. It's great to have the opportunity. I'd just like to start with a question. How many of you think of banking and finance first when you think of investor-state arbitration? Well, although it may not be the first sector you think of, investor-state arbitration is more important than ever with the recent turmoil in the international banking sector. In just recent months, we've seen Silicon Valley Bank, Silvergate Bank, and Signature Bank fail in the United States. We saw quite recently Credit Suisse be taken over by UBS under the stewardship of the Swiss government. And in that process, its AT1 bonds were completely written down. And in the process of that, of resolving the crisis or around Credit Suisse, the Credit Suisse shareholders were going to be bought out with one UBS share for every 22 Credit Suisse shares, something like a 60% loss for shareholders of that company. The AT1 bond holders have been completely written down, supposedly on the basis of a provision in the bond prospectus that allowed those bonds to be written down in the case of a viability event, specifically in order to preserve the capital adequacy of Credit Suisse and other issuers of that type of bond. So we've seen some major economic and financial consequences already of this latest spat of banking crises. And I think it's still too soon to know whether we've seen the end of the banking crisis or whether perhaps the worst is yet to come. These things sometimes unfold quickly, other times not so quickly. And I should say, just to pull back from that set of events, this is really just the tip of the iceberg. If the United States were actually to default on its sovereign debt in the coming days and weeks, that would be a cataclysmic event for the financial sector and for the global economy more generally, and would certainly stimulate a lot of disputes. Historically, financial crises have been one of the major causes of investor-state disputes in the banking and finance sector. So, just to give a few examples, we saw this in the Argentine economic and financial crisis of 2001, 2002, both banking and finance and other disputes. We also saw this following the global financial crisis, and as well as its aftershocks, most notably in Greece, where the events underlying many of the investor-state arbitrations really dated from a few years after the global financial crisis. And even in this latest banking crisis, we see Credit Suisse has and the actions taken regarding Credit Suisse have already resulted in threatened arbitration by bond holders, the AT1 bond holders from both Singapore and Japan, and perhaps we'll see other countries as well. And I think such claims by Credit Suisse bondholders will actually combine two of the most challenging, historically challenging issues that we've seen in banking and finance investor-state arbitration. And I think these are the issues of what is the legal status of debt instruments? Are they investments? To a lesser degree, where are they located? And then we also will see the paired issue of the treatment of emergency stabilization measures or emergency measures more broadly taken against banks. That has been a recurring topic in cases in this particular subfield. And interestingly enough, the Credit Suisse situation may combine those two issues because you have emergency measures taken against Credit Suisse that actually, in this case, instead of affecting the equity holders, have affected the debt holders. So I think it's therefore worth taking stock of what has happened in the last few years in this field. And I'm just going to, talk about, roughly the cases that have wrapped up in 2001 or 2021 and 2022. And I think in the last few years, we've actually seen tribunals get somewhat more aggressive. Historically, tribunals have struggled, I think, with how aggressively to wade into the issues in what is essentially a very heavily regulated sector that has close connections with questions of public policy, economic policy, monetary policy. Prior to 2021, there were just a handful of cases that led to public payments, whether those payments resulted from settlement or from awards. But we've seen a number of cases just in these last 2 years that have actually led to payments, or at least to awards of damages. And I think these cases provide potential indications for where this subsector of investor-state arbitration is going in the future. So I plan to review just the most recent developments in the debt and banking areas, since these are the most topical, and then just mention that there are a few other interesting cases that have emerged in the last couple of years. So first, on the legal status of debt instruments, I think we've seen several cases that confirm that debt instruments, at least in principle, depending on the treaty text, may qualify as investments subject to treaty protection. Obviously, a debt instrument, so a loan, or in the case I'm going to specifically talk about, sovereign bonds, looks somewhat different than your classic investment in a mine, in a factory, in an oil field. Physical things. These are not physical things. These are legal instruments. And so I think historically there's been debate before tribunals as to whether or not they were investments that would qualify for treaty protection. Well, in just last year, we've seen the Gramercy versus Peru case reach a final award. And this case addressed the interesting issue of whether certain highly specialized bonds in Peru should qualify as an investment, among many other issues. The bonds in this case were issued to Peruvian citizens in the 1970s as part of an agrarian reform in Peru, in which land was expropriated and the citizens were nominally compensated with these agrarian bonds. Gramercy, a private equity fund, acquired these bonds in the early 2000s. And the crux of the issue before the tribunal, at least on the merits, was whether the state had unfairly changed the valuation method for the bonds at a very high level of abstraction. But before reaching that merits question, the tribunal had to determine whether these rather unusual sovereign debt instruments were actually investments under the Peru-US FTA. And the tribunal found that it did. I think this question was relatively easy for the tribunal, in part because the Peru-US FTA, unlike many treaties, expressly notes that bonds are qualifying investments in its enumerated list of investments. Somewhat more interestingly, the tribunal did conclude that The bonds also had the characteristics, the inherent characteristics of an investment, looking at 6 different factors: commitment of capital, expectation of gain or profit, assumption of risk, which are kind of classic elements that tribunals have looked at, but also their duration, non-commercial character, and the fact that they were actually securitized. So I think based on this case, we can see that this case adds itself to a list of about 4 other tribunals that have found that bonds do qualify as investments, against one tribunal up to the present or one significant tribunal up to the present that found the opposite. I think for the interest of time, I'm going to just now skip to one of the interesting developments in the permissibility of emergency measures in the banking and finance sector. I think the recent cases solidify the principle that discriminatory or publicly motivated emergency measures may indeed breach an investment treaty. As I think I've noted before, bank tribunals have struggled with where to draw the line in their regulation or their oversight of state measures taken in the banking sector. So in 2021, the Cyprus Popular versus Greece Tribunal, which actually, according to public reports, the award is not public, issued a damages award in the $40 to $60 million range, based on the Greek government's failure to offer emergency assistance to a bank. That tribunal found that there's no general obligation to provide emergency assistance to a bank that's failing, but that if the failure is discriminatory in nature, it may breach a treaty. I'm just basing this on public reports. Again, the award is not public. I think also in very recent years, or I think in the last year, less than a year, the Bank Melli versus Bahrain Tribunal also confirmed that politically motivated forced administration and liquidation of a bank may breach a treaty. So at least in this, on more extreme fact circumstances where the regulatory measures taken towards the bank are not taken in good faith, it seems that tribunals are willing to step in and find and supervise and find breaches of investment treaty protections on the basis of measures taken against banks that are allegedly failing or engaged in improper conduct. So I think we do see some very interesting developments in these 2 areas that seem to kind of consolidate earlier patterns of decisions, and it'll be extremely interesting to see how these play out in the recent set of banking crises, or banking failures, banking crises, especially in the Credit Suisse case, where it looks like we are going to have investor-state arbitration proceed in the coming months and years. Given the amount of time, I'm going to just stop there and pass it back to Berglund. Thank you very much.
Thanks, David. So I want to turn to Michael now. I'd be really interested to hear kind of your perspective. David already spoke about this a little bit, but 2023 has been a pretty interesting year so far in the industry, and it would be really interesting to hear from you, sort of as somebody who's worked in the banking sector and knows it very well. Can you kind of help us understand, like, what are some of the key causes of these problems that we're seeing now in this particular potential crisis that's unfolding before us?
Yeah, sure. First of all, thank you for having me, everyone. So the key macroeconomic driver in the current crisis in the US is clearly the rate hikes that were done by the Fed starting in March 2020, so 2022. So the Fed started in March, and it executed 10 rate hikes from 0.25% of the target rate to 5.25% now, and that was the fastest increase in rates that we have seen since the 1980s, and it affects banks in different ways. And the first most obvious is that banks have lost a lot of deposits in the US, and that's simply because money market funds started to become more attractive. They started to provide higher yields than bank deposits. So bank depositors started to withdraw deposits pretty much very close to the start of the rate hikes. Bank deposits peaked in April 2020 to 22, and banks have now lost about 1 trillion in bank deposits over the last 12 or 14 months. And that development was not even across the sector. So some banks suffered much more from that than others, and that's the main cause for the 3 failures of large and mid-sized banks in the US, being first of all Silicon Valley Bank, then Signature Bank, and finally the biggest of them all, First Republic. So starting with Signature Bank. Signature Bank was a Californian bank that was servicing the tech industry, and it had grown rapidly over the 2 years up to the rate hikes. It had actually tripled in size, its balance sheet, to more than 200 billion. And all that was driven by a lot of venture capital funding that was flowing into the tech industry. And those tech companies didn't have immediate use for those funds, so they parked them as deposits with Silicon Valley Bank mostly. And Silicon Valley Bank had to do something with those deposits. So what they did was they reinvested them in longer term assets, mainly US government bonds and agency bonds. But when the rate hikes started, also the venture capital funding was drying up because it was less attractive for venture capital funds to invest in the tech industry at higher interest rates. So all of a sudden that growth machine went into reverse at Silicon Valley Bank, and Silicon Valley Bank had to reduce its assets again. Now, the problem was that because rates had gone up, those assets, including US government bonds, had lost in value. So on the 8th of, on the 10th of March, 2023, this year, Silicon Valley Bank announced to the public that it had to sell 21 billion in assets at a loss of 1.8 billion. And it also announced that it would need fresh capital in an amount of 2.25 billion. So it's important here to understand that most of the deposits that SVB had were unsecured because they were higher than $250,000. So that announcement actually spooked investors in SVB, and the next day SVB reported that it had lost 40 billion in deposits in just one day. That's more than 20% of its existing deposit base. And on the evening of that day, the 11th of March, it actually found that it would have additional outflows the next day of 100 billion in deposits. So that's 140 billion in deposits within a matter of 2 days. That's more than 2/3 of the bank's overall balance sheet. So obviously the bank did not survive that. And on the next day, the regulator closed down Silicon Valley Bank and made the FDIC the receiver. So to avert depositor panic, because that was obviously an issue with other banks as well, where deposits were uninsured, the FDIC actually insured the entire depositors of Silicon Valley Bank, that they would get their money back. That didn't help. So 2 days later, so it might have helped, but it didn't stop the panic and the crisis, because 2 days later, Signature Bank, which was a New York bank, went under for the same reasons. So on the 12th of March, Signature Bank was put in receivership by New York State. Now, Signature was a little bit different because it was an East Coast bank, not West Coast, and its main business was commercial real estate lending, and it had ties also to the cryptocurrency industry. But it also had this large percentage of uninsured depositors. So it also basically experienced a bank run, and it went under within a matter of 2 days. Again, the FDIC insured all of the depositors in the case of Signature Banks, and again, that was not enough to stop the panic. So on the 1st of May, we saw the biggest bank failure. So that was First Republic, which again was a West Coast bank. First Republic was seized by the regulator and was sold on the same day to JP Morgan. So, and our First Republic shared some of the problems that the other two banks had. It had also a large volume of uninsured deposits from wealthy West Coast clients. It had a large amount of assets in the real estate industry, which on the books, in terms of book value, has lost value. And it also experienced a bank run. Slower than in the case of the other two banks. First Republic, the problem started around the same time as SVB, with its share price dropping a lot. But it took basically 6 weeks or so until it finally went under, because there were certain rescue measures that were tried in between. So in summary, all three of those banks in the end went under because they suffered bank runs in different speeds. What I find interesting in all three cases are two aspects. And the first one is the speed at which that happened. So when you see a documentary about bank runs, you typically see images from 1929 of black and white people standing in front of bank branches. That's not obviously the reality anymore. So today, bank transfers can be done online. They can be done very quickly and easily. And more importantly, also information propagates extremely quickly and can turn into panic in a moment's time. And the Fed actually discusses that in its review of the SVB collapse. And that's a quote here. The Fed finds that the bank had experienced highly correlated withdrawals from SVB's concentrated network of VC investors and technology firms who, fueled by social media, withdrew uninsured deposits in a coordinated manner at an unprecedented rate. So that's something fairly new. The other aspect that I find interesting is short selling. So all three bank stocks were impacted by increased levels of short selling, which means investors that basically bet against the share price of a bank. Now, the share price of a bank is sometimes the only health indicator that is publicly available about a bank. And particularly in the case of First Republic, the share price dropped within a few days around the SVB collapse by 90%. And I believe that clearly has an impact on confidence in a bank, and it can start a vicious cycle where lower share price can mean higher deposit outflows meaning more share price decline, and so on. So that's why there currently is more and more discussion also about the question whether regulators can and should impose specific short selling bans on banks, like it did after the financial crisis. Only after the financial crisis it did it for the entire industry. Discussions are about specific short selling bans.
So that's actually really helpful, Michael, to help understand what's been happening in the United States. But it seems like it's not been isolated to the United States. There's also been some crises on the other side of the Atlantic. Can you help us understand a little bit what happened in terms of Credit Suisse and then that surprise takeover by UBS? Are those related? Like what was sort of the cause there?
Yeah, sure. And David mentioned some of it already. So yes, Credit Suisse was taken over by UBS on March 19th, which is just precisely a week after Signature Bank's collapse. So 5 days before that, Credit Suisse had announced its annual numbers for 2022, and it had reported a loss of around 7.6 billion for 22, and it had also reported that it had lost in that year around 40% of its deposits, and most of that in the fourth quarter of 22, and most of that in October of 22. So it had experienced also enormous outflows of liquidity already in 22. On the next day, Credit Suisse announced this to the public that it will take 50 billion in liquidity from the Swiss National Bank, 50 billion Swiss francs, that's 54 billion US dollars. And Bloomberg reports that the biggest investor in Credit Suisse, which is Saudi National Bank, publicly announces that they would not increase their shareholding in Credit Suisse. So on the same day, the share price drops by 26%. It's worth noting that the share price had been slipping for years already. So Credit Suisse's market capitalization had been suffering for quite a while up to that point. So on the 19th of March, which was a Sunday, both banks reported that UBS would take over Credit Suisse for a price of $3 billion US dollars. It was also reported by the Swiss regulator that the Swiss National Bank would provide a liquidity line of 200 billion Swiss francs, roughly 210 billion US dollars. And like David mentioned earlier, it was announced that the Swiss regulator had ordered Credit Suisse to write down all of these so-called AT1 bondholders, and they lost the entire value of their investment, which was 17 billion US dollars. So in the end, Credit Suisse seems to have suffered from a very similar fate as the three US banks, which is a loss in the liquidity, a sharp drop in deposits and investor confidence. But it seems to be correlated in time to the US cases, and that probably didn't help to reduce panic in the market. It did the opposite. Mm-hmm. But it's fair to say also that Credit Suisse had its own problems from the past, which were not related to the US banking crisis.
So what kind of disputes can you imagine coming out of these types of crises?
Yeah, David mentioned that already also. So one group of claims seems to be coming from Credit Suisse's AT1 bondholders. And to understand that a little bit more, AT1 stands for Alternative Tier 1 bonds. And those are instruments which were created after the financial crisis. I believe the first bond was issued around 2010. So they work as follows. When a bank's capital falls below a certain threshold, the bank is allowed to either write down those bonds, typically completely, or convert them into equity. And in the case of Credit Suisse, the AT1 bonds were write-down bonds. And this is what actually happened. The regulator, the Swiss regulator, FINMA, ordered Credit Suisse actually to write down those bonds. Now, what is unusually in the situation of Credit Suisse is that the recovery order was changed. So Credit Suisse's shareholders actually received 3 billion from the sale, and the bondholders received nothing. Typically in bankruptcy or bank resolution, the order is different. So shareholders suffer first, and then when all of the shares have been written down fully, then bondholders will start to suffer as well. And that happened, for example, in the case of Banco Popular in 2017. But it didn't happen in the case of Credit Suisse, and the decision by the Swiss regulator spooked investors in the market for AT1 bonds. So on the day after the merger, the Bank of England and the EU come out with a statement that says, in the case of bank resolution or bankruptcy, we will respect the typical recovery order. The problem here was that in the case of Credit Suisse, the Swiss authorities did not call the process a resolution. They didn't put Credit Suisse in resolution, even if it looked like one. So some law firms are actually questioning that decision. So they're asking that question: why did the authorities not place the bank in resolution and then in resolution respect the typical recovery order? So, and another important question seems to be, and David touched on that already, the question whether the Swiss regulator FINMA had the authority to write down or order a write down of the bonds in accordance with the contractual language in the bond prospectuses. FINMA argues that it had, because the Swiss National Bank had provided extraordinary liquidity assistance. And in the view of FINMA, this constituted a so-called viability event, and viability events are defined in the prospectus, and they would have allowed FINMA to order a write-down. Now, the issue is a viability event requires assistance which improves the capitalization of the bank, and not only liquidity, but the assistance provided by the SNB had only liquidity and not the capitalization of the bank. So that is something which investors are questioning. And actually, just this week, there was an article in the Financial Times that also Credit Suisse, around the day of the sale, had questioned that interpretation. And Credit Suisse exactly points out to that bond contract, to those bond contracts, and says there was no assistance on the capitalization side, so this was not a viability event. So different groups of bondholders seem to be preparing claims in relation to the Credit Suisse matter, both in local courts and in international, under international treaties.
Yeah, it'll be interesting to see what happens. So I want to turn to you, Danielle. So I think, David, it was sort of nice how he started this. He said, well, you know, is this really the kind of investment you would have thought of when these treaties are negotiated and so on? It's not necessarily the most intuitive type of investment that we would think, but we really are seeing a lot of disputes in the past, and we're probably going to be seeing a lot more. You know, as somebody who's worked on cases both in this industry and others, like, how do you sort of see these cases fall, sort of fitting in with the case law and with the universe of investment arbitration more generally?
Thanks, Berglund, and thanks also to the organizers for the invitation to join the panel today. So I think there are three particular characteristics of financial services claims that I'd like to highlight under investment treaties. The first one is sort of a combination of procedure and substance. These types of claims are more likely to lead to mass or aggregate claims. And in particular, unlike many other kinds of claims, bondholder claims really lend themselves, I think, to bring as mass claims. From a factual perspective, the investments are usually uniform, at least within certain classes of bonds, and they're likely to be affected in the same way by the government measure at issue. For example, a haircut of a certain percentage imposed on a certain class of bondholders. And this addresses a typical issue, a common obstacle to collective claims, namely that there isn't a sufficient commonality of facts and circumstances to allow a tribunal to make a common ruling. And from an economic perspective, bonds are more likely than many other kinds of investments to be both insufficiently high value individually to make a solo claim worthwhile, but on the other hand, able to be aggregated in a cost-effective way due to the factual similarities that I've mentioned. There has, as many in the audience are no doubt aware, been a heated debate as to whether such mass claims are permissible under the relevant investment treaties and or the arbitral rules that govern a particular dispute. So far, the answer has generally been yes. But there has been some very vociferous dissent, and so I don't think this can really be considered a settled issue at this point. And there may also be consequences in terms of security for costs. There have been tribunals recently that have said, yes, we'll let this claim go forward, but we recognize that this is not a typical situation. It may be difficult for the respondent state to collect on any cost award, and so sort of to counterbalance the letting the claim go forward, we're going to ask for, or order rather, security for costs. And then also there's been a debate as to whether these bonds qualify as investments, which David has mentioned, and he's going to discuss a little bit more shortly. The second sort of particular characteristic of these kinds of cases, financial regulation cases, like tax cases, are particularly likely to raise police powers concerns. And David flagged this as well in his introduction. So a state's so-called police power is the sphere of regulation within which the state has discretion to act without incurring international liability, provided the state meets certain basic requirements like acting in good faith. So as Michael mentioned, the financial sector is highly regulated. There's also the potential for fast-moving problems and contagion within the financial system. I think, fortunately, we've all seen examples of that. And in addition to these sort of institutional or sector specific concerns, there are also potential concerns about consumer protection and other sort of individual facing issues. So these factors taken together mean that these claims may have particular challenges for investors absent some significant aggravating factor. In particular, tribunals are very reluctant to second guess regulators as long as they're acting in good faith. Typically, tribunals have rejected liability unless the measures are arbitrary or wildly disproportionate, which can effectively be a measure of the regulator's good faith. And tribunals are much more likely to find liability where the financial measures were taken for an improper purpose. And you can compare this in the tax sphere to the UCOS cases, for example, where tribunals said an actual tax regulator acting in good faith would not have taken these measures. These were not actually intended as tax measures, but rather as expropriation. So for example, where the measures target a foreign investment, where there's a political motivation behind the measures, these are the kinds of circumstances where tribunals have been more likely to find liability, effectively where the state is using financial regulation to achieve non-financial goals. And then the last point that I just wanted to flag, third characteristic, financial sector claims can arise out of a particularly wide variety of kinds of measures, each of which raise their own issues. And we've heard a little bit about these already. So there are consumer protection related claims, bank stability and licensing measures, bonds and other financial instruments, interference with the repayment of loans. So all of these different kinds of measures have given rise to investment arbitration claims. And so depending on the type of issue or the factual circumstances involved, it may actually be the case that the most analogous precedents, we don't have precedent, but the most analogous comparators may actually be outside the financial sector. So really just an impressive variety of different kinds of claims.
Yeah, thank you. Thank you, Danielle. So I thought maybe we could pivot a little bit and start. I think we've gotten sort of laid the groundwork here in terms of what causes these disputes and so on. But just talking a little bit more, kind of getting a little bit more in the nitty gritty of actually litigating these disputes. So this is something that Danielle and David and I have all litigated these kinds of cases. Michael, you've testified in these kinds of cases. So maybe we can sort of talk about sort of jurisdiction merits and quantum of these types of cases. So starting with jurisdiction, David, what are some of the jurisdictional issues that are sort of typical in these types of cases that you need to overcome as a claimant? Oh, I think you're muted.
Thank you. So by and large, the jurisdictional issues and admissibility issues that you come up in these cases are not necessarily distinctive from other areas in investor state arbitration. You can have all of the standard issues that you might have elsewhere, questions of jurisdiction ratione temporis. You can have issues of legality and the full panoply of the types of issues you see in other cases. And actually, even in many banking and finance cases, there are not necessarily distinctive issues. So, I mean, a lot of these cases don't deal specifically with, let's say, financial instruments like loans, bonds, derivatives. A lot of these cases are just about equity stakes in banks or insurance companies or pension management and that sort of thing. And those, well, I mean, they have some distinctive merits, and damages issues, but I think actually on the jurisdictional and admissibility side, the claims are not that distinctive from even just owning a mine or a oil field or what have you. I think where we really get some interesting issues are when the cases center around what I would call financial instruments, pure contractual or sometimes securitized contractual obligations in the form of bonds, like bonds, loans, because there you have this completely immaterial investment. And as I mentioned very briefly in my introductory remarks, I mean, there you get the set of issues surrounding are these things investments under the definition of an investment that appears in an investment treaty? If you're in an ICSID arbitration, you'll get the question of, do these supposed investments have the characteristics, the objective characteristics of an investment pursuant to Article 25 of the ICSID Convention? So the Cellini sort of analysis, although I mean, you get different combinations and permutations of how that works. And even under sometimes under treaties, you'll also get this, especially certain more modern treaties will expressly say that the investment has to have characteristics of an investment, and that then you get into this same sort of debate as to whether these things, are they really investments? I mean, they're not foreign direct investments of the kind of the classic sort, but well, I guess if you talk to somebody on Wall Street, you know, buying bonds is probably qualifies as an investment in their sort of sense of the word. But so you're in that sort of space of debate. I think the other interesting question that comes up, because these financial instruments are non-material in nature, is, well, where are they located? I mean, there's no physical, there's not necessarily any physical, physical location of it. I mean, I guess in some older bonds, I guess, well, in the Gramercy case, they actually had written papers, but I don't think you would say that the investment is where the physical paperwork is located that attests the bond certificate is located. It's something else. And so tribunals have struggled with this question to some degree in the cases. I don't think they've come to wildly different viewpoints. An early case, the Abbaclat case, did touch on this, and it concluded roughly that the location of one of these investments is where the benefit from the financial instrument was received. So generally speaking, if it's sovereign debt, it would be in the location of the where the sovereign is that issued the bonds in the first place. But I mean, it is an interesting question, because I mean, sometimes, not always, these even bonds will have intermediaries. You may have an interest in a bond as a retail investor or maybe an institutional investor, but you may not actually own the original bond. That may be held by an intermediary that then reissues interests in that bond. So that complicates the analysis one level further. And then also you can have other issues like, well, one of the things about securitization and bonds in particular, the whole point is that you can have a secondary market for these things. And so a lot of times investors will acquire these things in the secondary market. Again, I mentioned the Gramercy case, which is a somewhat unusual case, and I'm not sure you'd want to exactly describe what happened there as a secondary market, but you didn't. Gramercy acquired its agrarian reform bonds from the individuals who originally received them from the government. So it wasn't exactly receiving them on the primary market in that case. So you have these interesting issues about location that arise from this set of characteristics of financial instruments as well, that I think in cases that surround these financial instruments can really be the subject of quite extensive debate in the cases.
Indeed.
Thank you.
So Danielle, moving on to the merits, are there some unique issues that arise on the merits on sort of liability for these kinds of claims?
Sure. And just before I do that, a quick point on jurisdiction. I think one thing that has really caught my eye in these cases is how tribunals have looked at the list of example investments in the treaty at issue. I feel like in a lot of cases, the tribunals really are not particularly concerned with which specific kinds of contracts, for example, or debt instruments are identified in the list of examples. But precisely because bonds are not a typical sort of more physically embodied investment, it has really come up in some of the cases. And then I know Brigitte Stern also drew an interesting distinction in one of her dissents between bonds where the proceeds are used, for example, to build a factory or to build some infrastructure versus bonds that are issued for the purpose of raising general government revenue. So these are, I think, other interesting ways that bonds raise particular jurisdictional issues. Sorry, David, did you want to? And then turning to the merits. So one of the issues that I've already mentioned, police powers, I think gives an added oomph to the generally applicable presumption that the government is acting in good faith, right? So in pretty much any investment arbitration, a tribunal will generally start from the presumption that the state is acting in good faith. So as a claimant, how do you show that the government, or more specifically the regulator, went beyond the bounds of what is internationally acceptable, apart from just looking at the impact or the nature of the measure itself? So looking at some of the cases, you can point to, for example, public statements by politicians or by the regulator regarding the reason for the measures. There have been cases where public statements have made clear that the measure is intended to target specific investors, foreign investors more generally, or that there is some other kind of purpose behind the measure that doesn't necessarily align with a traditional regulatory measure or regulatory goal. There are other circumstances that investors have pointed to, for example, upcoming elections, which may have provided some motivation for the measures at issue, and also a comparative analysis of similar types of measures in other jurisdictions. And again, this has also been done in tax cases to be able to say, okay, you're saying this is a particular kind of measure intended to accomplish a particular goal. Let's look at how other jurisdictions have accomplished that same goal. And the idea being, if your attempted measure to achieve that goal is wildly different from what other regulators have done, that in itself suggests that perhaps the motivation here was something different. And then there's always the hope and disclosure that you'll come up with something particularly useful, especially with respect to the state's internal assessment of the measure. So for example, did they consider alternatives? Did they consider the impact on the particular stakeholders? Is there any evidence of animus or discriminatory treatment? Just generally to be able to assess, did the government engage in an ordinary and fulsome regulatory assessment here, or were they acting potentially for other reasons? And then secondly, in every case, as the claimant, you need to persuade the tribunal that it wants to decide in your client's favor, right? You have the pure facts and the legal arguments, but it's also a story, right? And you want to persuade the tribunal that they're doing the right thing by deciding in your client's favor. So this can sometimes involve a bit of PR work on behalf of your clients. I think we all know, in the wake of the global financial crisis, institutions in the financial and banking sector were not necessarily the most popular, and they haven't always been the most sympathetic investors. And I think we've seen the same also with investment funds, for example, that focus on distressed assets in particular. And this doesn't mean that they don't have good claims, right? It just means that when you present your narrative to the tribunal, you need to be conscious of the broader circumstances and really work to help the tribunal understand the circumstances of this particular dispute and this particular investment, so that they can have the best understanding of your client's case.
Yeah, that's good advice for any case.
So, and then I see we had a question about the major jurisdictional issues that each party should have fulfilled prior to making a claim. So I don't know, David, whether you want to take that one. I mean, I think you typically have your covered investor with your covered investment. So in the case of a corporate investor, you're looking at usually a corporation that's incorporated in the home state and then legitimately owns an investment that's covered by the treaty. And there, I think it really comes down to the definition in the treaty, especially when you have these sort of, I don't want to say borderline investments, but less typical investments, which originally back in the day were sort of contracts, right? How could this contract possibly be an investment? And then now with bonds, I think is sort of the most common. But I think even loans can raise interesting issues, right? You have loans that are associated with a freestanding investment, which I think pretty typically are considered investments themselves. And then you have loans that are sort of issued commercially on a more standalone basis, which I think could raise more interesting issues in terms of whether the loans themselves would be an investment in that case, whether they would be an investment taken in consideration with the larger business. But I'm gonna hand over to David at this point if there's anything that he wanted to add there.
Nothing that significant. I guess I would just add, you also would, as I think I mentioned in my prior remarks, you would need an investment in the right location. So it actually has to be in the territory, generally speaking, depending on the treaty, but it would have to be in the territory of the host state of the investment, the state that you're actually bringing claims against, which can be complicated, again, in the cases of loans, bonds, and derivatives, where the location is perhaps a bit less clear than that of a factory or an oil field or a mine. And then finally, you also, the investment and the claim, well, the claims have to have arisen at a proper time. It has to have arisen when all of the other requirements were generally satisfied, and it also has to have arisen after the relevant investment treaty has gone into force. That sometimes comes up in, well, these cases. It can also come up in any other sector, but there have been a couple of cases against Colombia in recent years where this was actually at the heart of the state's defense, that the bank collapse happened before the treaty actually came into force, and so there was a lack of jurisdiction ratione temporis.
Yeah, and I think also another thing, sort of a practice point, I think for any case is you want to know the specific treaty instrument that you're looking at. Some of the more modern treaties also add some additional hurdles in terms of, for example, needing to waive all domestic remedies, needing to withdraw cases that you might have that are pending. And then of course you need to be thinking about if there's a statute of limitations, let's say there's a 3-year statute of limitations, but then there's also a 90-day sort of, you have to a notice period and so on. So you need to be kind of thinking backwards in terms of when you're in a position to file to make sure you've withdrawn everything and so on. So I think there's a lot more hurdles in my experience in the more modern treaties than in the older ones that you need to be worrying about, sort of those temporal and sort of the hoops, sort of the I's that need to be dotted and the T's that need to be crossed. So yeah, so there are then time bars. You have to be thinking about, when did the treaty enter into force? Was the dispute, when the dispute occurred, was there already an entering into force? Was your investment, the investor, incorporated in a country that has a treaty? But then you need to be thinking about, there are some time bars in some of these treaties. For example, the one that was at issue in Gramercy, there's a 3-year statute of limitations. So you have to make sure that you are filing. And so then there can be a argument between the parties of when did the dispute arise, because that can have an impact on whether you can bring the claim or not. And typically you do need to give notice to the state, a notice of intent, often 90 days before the actual request for arbitration. And so the request for arbitration would be the relevant date in terms of the time limits, but then you have to be thinking backwards in terms of the notice. So hopefully that addresses the questions on the jurisdictional and then the merits, but it would be interesting to talk about quantum. That's obviously really, really important too, is valuation. And so Michael, that's sort of the piece of the case that you're typically involved in as an expert who's testifying on these issues. what are some specific unique aspects on the valuation side for these kinds of cases as compared to others?
Yes, sure. Yeah, I can think of three aspects that are materially different to other industries. And the first one is obviously regulation. So other industries have regulation too, but banks are heavily regulated for good reasons, and their regulation is very banking specific. So when you value a bank or a financial instrument and make forecasts, you have to make sure that you consider all of the regulatory aspects of a valuation, and that can become quite detailed and difficult, and particularly difficult to explain to a tribunal pretty quickly. And the other aspect is beyond regulation. Bank valuations are different because banks use both sides of the balance sheet for their business. So deposits are an integral part of their business model. You also have to have a valuation model, which is called in banking equity valuation, which puts the debt as an integral component into the valuation. Typically in an industry valuation, that becomes an afterthought. You value the firm value and then you deduct debt at the end. So both of these aspects make bank valuation quite different from many other industries. And as I said earlier, difficult to explain also to a tribunal that might not be so familiar with banks. And the third aspect I like to mention is resolution. So resolution frameworks are something quite new. Many frameworks were created after the financial crisis, and they haven't really been tested. So resolution is something very stressful. So it usually happens over the weekend. The regulator has a lot of responsibility to get it right. And there's a lot of discretion. And the question there is always, was what the regulator did the right thing? And of course, there are different legal standards, which Danielle mentioned. But I also like what Danielle mentioned about the story that experts have to tell, because banks can be in resolution for quite different reasons. So bank can have, like in the recent cases, in resolution because there was a bank run, because they had a liquidity event. But banks can also have underlying capital problems, which are more difficult to solve. So the question is always, what was it? And was it worth for the regulator to save the bank? Were there any measures that would have been more targeted to that specific situation of the bank? And particularly, was there a chance of survival had the regulator done something differently? And that's also something that is not easy to explain, that requires a lot of detailed analysis of a bank. So you need to go down deeply into the data of the bank. You might not always have that data because you might be on the side of an investor who only has public information at its disposal. So that becomes quite detailed quite quickly. So in summary, I think bank valuations are quite different. They require an expert to really have a deep understanding of regulation and be prepared to go into the weeds and explain them, which are two different things, obviously.
Yeah, and that's always, I think a really interesting part of our practice as counsel is that we ourselves maybe aren't experts in the particular industries that we happen to be litigating cases. And so it's so crucial to have a good expert, but then also helping that expert to sort of translate things into plain English. Yeah. Let's see, we have a question here. So it says, will you please share your findings on the outcomes of an evaluation, if any recipes of any jurisdictions? I don't know if there's anything you wanted to add on that, Michael.
Yes, what I mentioned earlier, I think what is crucial is sometimes valuation can be quite a digital outcome. It can mean, yes, that bank had a chance to survive and there were proper measures available to a regulator to provide for its survival or not. And that's a quite difficult thing to answer. And particularly it's difficult to answer after the financial crisis, because what we found is that there are now banks moving at different speeds. So there were those banks that were rescued directly after the crisis. They had the opportunity to shed problem assets. They were recapitalized right away, and basically they were giving a new lease of life. There were other banks that either for whatever reason did not receive government aid, but those banks might still have had problem assets. And more importantly, they had to fulfill the new regulatory requirements. So basically banks had to have double the capital that they had before the crisis. So they had to raise capital, they had to shed assets. And in some cases that can take a bank 10 years or more. And if a bank ends up in resolution just before that process is finalized, you end up having to answer the question whether that bank had just been at the end of the resolution of the recovery, or whether it was chronically ill. And again, that's a difficult thing to answer.
Yeah, and just something to add there that, you know, an interesting sort of tension here. Typically speaking, tribunals are very clear that they're not planning to second guess the regulators, right? Like, did they make the right decision? Did they make the best decision? The question is, did they make an internationally lawful decision? But at the same time, you end up, I feel like, litigating whether they did make the right decision, right? Both parties are sitting here saying, you know, they should have done this, they should have done that. And I think the purpose of that is to get at, were they really acting in good faith? Did they make a proportionate decision? Did they make a good faith decision? But when you get into the nitty-gritty, there's a lot of argument about whether they did in fact make the right decision, even though the tribunals are pretty clear that that's not their mandate. So I think there can be some tension between the evidence presented by both parties, from the more factual perspective, from the expert perspective, and then the overarching legal arguments, which may have a slightly different tenor or a slightly different focus, which is not necessarily, was this the right decision or the best decision, but was this an internationally lawful decision?
So we're kind of coming towards the end here in terms of our scheduled time. So I know there's some questions that have kind of come through, if anybody wants to address those, but I also just wanted to give each of you an opportunity, you know, sort of as we're wrapping up, to just add any additional points that have been prompted by what other speakers have said, or sort of your thoughts about where things are headed in the future. Maybe I can start with you, David, if you want to kind of give some concluding remarks.
Absolutely. I think the one thing I'd like to just say in conclusion, rather than prognosticating about the future, which I think is difficult to do at this moment, maybe if we had this panel in like 3 weeks, it'd be have more things to say. But I just don't want to leave the attendees with the impression that banking and finance cases are only about banks and bonds, because they're not. I mean, this can cover a wide range of different industries. I mean, just a couple other examples that I was going to just mention in my opening remarks that I thought came up in recent years. I mean, we have, for example, the BBVA case against Bolivia, which wrapped up last year. And this was a case that regarded management of the pension fund of pension funds in Bolivia. Bolivia had undertaken a transition from a private pension system to a public pension system by effectively nationalizing the pension system in 2010. And then it had this transition period that lasted at least through 2022, the date of the award, according to the tribunal. That was really the subject of the dispute, because the private administrators alleged that they were left in this sort of limbo where they hadn't quite been nationalized, but hadn't quite not been nationalized. And this was the subject of dispute. Or just to give another example from a case I worked on, I'm not going to comment on the actual substance of it, but in the Moll versus Croatia case, one of the major issues that came up there was securities regulation and whether the Croatian securities regulator, HANFA, had properly or improperly or abusively regulated the securities market in Croatia in a way that, allegedly negatively affected our clients' interest. So that was so you can have these issues of securities regulations. So it's a big field. Finance itself, banking finance itself, is apart from arbitration, is a massively complicated, multifaceted, multidimensional field that is really only limited by, hesitate to say it, but human creativity. And I think the types of cases that you see in international investor state arbitration can match that entire range of creations that we see in the field.
Thank you, David. Michael, do you have any final thoughts?
No, only that you didn't ask me to forecast whether the crisis is over or not. I'm grateful you didn't ask me.
You don't want to be recorded on that. Yeah, that's going to be, we'll see that. We'll have to reconvene in a year and see what's happened in the meantime. Danielle, maybe I can give the final word to you.
Sure. So just a tiny bit of prognostication. I think we're going to continue to see quite a few claims in this area, both because of the recent turmoil that we've been discussing, but also, just as David mentioned, recently these cases have been successful. Certainly not all of them, but there have been several recent notable cases in which the claimants have succeeded, which I think always stimulates potential future claims. But sort of to temper that, hopefully these recent decisions will provide some guidance on what a successful claim looks like and what the permissible bounds of government regulation are in this sphere, which I think will be helpful for both investors and for regulators going forward.
Thank you so much. Thanks, everyone. And to all the participants. Is Maria Lucia still here? I think I can hand the baton over to you.
Thank you, Verlene, and thank you, Danielle, Michael, and David. And I think this was a terrific panel. I actually learned a lot, and I think that we should keep exploring this topic for our next editions. So please, all of you, we will keep you posted on the topics for the next year. I would also like to invite all our participants to the last session of this week. We have in 40 minutes a session on investment arbitration and international humanitarian law. And then we will have a session on the code of conduct. So those who are based in Washington, D.C., don't miss the session of the code of conduct and join us at the offices at Crowell and Moring. So I think with this, we can move to the breakout rooms and have like a very informal conversation with our stars. So thank you so much for our panelists and our participants. And see you next year.
Thank you.
Thank you.
Take care.